Two people. Same city. Same age. Same salary. And both of them just made a decision that will quietly shape the next 20 years of their financial life. Each one has $50,000 in savings. One chooses real estate. The other chooses the stock market. At first, both feel confident. Both believe they made the smarter decision. But here's the problem. Most people never calculate what actually happens when you include everything. Not just profits, but debt, risk, stress, time, maintenance, discipline, and emotional pressure over 2 decades. And when we run the full version of that calculation, the result becomes far more interesting than most people expect. Let's introduce them properly. We'll call the first investor Daniel. The second investor is Ravi. Both are 32 years old. Both earn around $55,000 per year. Both live in the same type of middle-income city. And both have exactly $50,000 in savings. Same starting point. Same financial opportunity. Completely different paths. Daniel decides to invest in real estate. He uses his $50,000 as a 20% down payment. That allows him to purchase a $250,000 rental property. He takes a 30-year mortgage at around 7% interest. His monthly mortgage payment comes to roughly $1,300. He rents the property for $1,800 per month. At first glance, this looks amazing. $500 monthly profit. That's $6,000 per year. And Daniel feels something powerful immediately. He is now a property owner. He has an asset he can physically see. He drives past it. He feels in control. He feels wealthy. But what he doesn't realize yet is this. Cash flow on paper is not the same as cash flow in reality. Now let's look at Ravi. He takes his $50,000 and invests it into a low-cost index fund. No leverage. No property. No tenants. No maintenance. Just broad exposure to thousands of companies. He also starts investing $300 every month. At first, nothing feels exciting. There is no physical asset. No monthly rent. No visible progress. Just a number in a brokerage account. And psychologically, it feels slow, even pointless. But something is happening quietly. Compounding has started. In the first few years, Daniel looks like the winner. He receives rent every month. He builds equity. He enjoys tax deductions like mortgage interest and depreciation. He sees property prices slowly increasing. Everything feels like progress. He feels smart. He feels ahead. Meanwhile, Ravi feels nothing. Small gains. Small drops. No excitement. No validation. But the difference is, one system is emotional. The other is mathematical. Now let's break Daniel's situation realistically. Because this is where most real estate stories become misleading. Even good tenants leave. On average, properties sit empty at least 1 month per year. That means, no rent, full mortgage still due, stress increases. Nothing stays perfect. Plumbing issues, appliance breakdowns, electrical problems, wear and tear. Average cost, 1 to 2% of property value yearly. That's $2,500 to $5,000 every year. These are the silent killers: roof replacement, HVAC system, water heater, structural repairs. These don't come monthly. They come in $5,000 to $15,000 shocks. If he hires a manager, 8 to 10% of rent gone instantly. If he doesn't, late night calls, tenant issues, repairs coordination, weekend work. Either way, it costs something. One bad tenant can cause 3 to 6 months unpaid rent, legal costs, damage repairs. One mistake can erase an entire year of profit. After all real expenses, Daniel's actual profit becomes much smaller. Instead of $6,000 per year, he might only realistically keep a fraction of that. And that's before counting his time. Now back to Ravi. At first, nothing changes dramatically. Year 1, small growth. Year 2, slightly more. Year 3, volatility continues. But something important is happening. He is not just earning returns. He is earning returns on returns. That's compounding. Ravi does nothing. No tenants, no repairs, no decisions, no emotional stress. His money is automatically distributed across technology, healthcare, energy, global businesses. He doesn't control it. But he owns a piece of the global economy. At year 10, things get interesting. Daniel's property has appreciated. His equity has grown. He feels successful. But when we subtract repairs, taxes, maintenance, vacancy, interest payments, his real net profit is much lower than expected. Meanwhile, Ravi's portfolio has grown steadily. No interruptions. No expenses. No breakdowns. Just consistent compounding plus monthly contributions. At this point, both investors are surprisingly close in total net worth. This is where most people get confused. Because emotionally, real estate feels like a winner. But mathematically, the gap is not as large as expected. Now we reach the long-term outcome. Daniel's property is now much more valuable. He may have fully paid off the mortgage. His net worth looks strong on paper. But he also spent 20 years of maintenance, financial stress cycles, time management burden, illiquid capital. Ravi's portfolio has also grown massively. His growth came from time, consistency, compounding, patience. And most importantly, he never had to manage a single physical asset. No tenants. No repairs. No debt pressure. Just long-term investing. At the end of 20 years, both investors often end up in a similar wealth range. But the journey is completely different. Real estate gives leverage, control, tax advantages. But also, stress, time commitment, concentration risk. Stocks give compounding, diversification, liquidity. But require patience, discipline, emotional control. And here's the truth most people miss: the biggest financial mistake is not choosing real estate or stocks. It is choosing without understanding the full system. Without including time, risk, stress, hidden costs, long-term behavior. If you found this helpful, subscribe to our channel for smarter investing insights.